Well, welcome back. As you can see, you are still watching the special broadcast on South Africa's Monetary Policy Committee meeting, the decision having taken place just a few moments ago. I can tell you it was a 7-minute speech that the Reserve Bank Governor Kganyago gave, in which ultimately he said what everyone expected to hear, that rates remaining unchanged, 8.25% this time around at the second meeting. Prime at 11.75%, as I did say, and it is quite notable that rates in South Africa have been at this level since July last year, which is, of course, when the South African Reserve Bank stopped its previous hiking cycle. The governor also making forecasts or giving the latest forecasts around growth. The growth has seen a tad but higher for 2024, 1.24%. But in terms of interest rate cuts, which is something that we have been talking about since the start of the year, it seems that hangs in the balance right now. The SARB expressing their concern around inflation in South Africa, latest print coming at 5.6% for February, being towards the upper end of their target band. We do know that the South African Reserve Bank likes inflation at 4.5%, which seems to be the level that they're waiting for to stabilize before making any moves on any rate cuts potentially this year. But let's bring in the experts for their take on the latest MPC decision that just happened earlier on. Annabel Bishop, a chief economist at Investec. We've got Koketso, Mano, senior economist for FNB, as well as Reza, Ismail, the head of bonds at Prescient Investments. To all of you, thanks so much for your time. Reza, I'm going to start with you, just given the fact that I'm looking at the market's take and not much of a reaction in the Rand following the MPC decision. Just any significant movements on your screen as the governor was delivering his latest pronouncements on the lay of the interest rate land?
Thanks very much for the time. Yes. The short answer is that none to speak of, right? So the two sort of quick moving indicators that one normally looks at would be sort of the front end of the yield curve, the front end being sort of largely the area that is in some sense captive to monetary policy. So there's been no pronounced reaction in the front end whatsoever, and ditto for the currency markets. And I think it's been and you have that phenomenon because I just think that development that we saw from the governor was so firmly within the market's expectations, both in terms of the traded markets and the general surveyed markets as well. So I think sort of par for the course, and the yield curve and the currency markets basically saying, as expected, no real reaction.
All right. To the economists now, just given the fact that we all saw your forecasts, and as Reza said, just as expected that there would be no move on rates this time around. But I'd like to understand if there's anything that you did learn today that you didn't know, delivered in the 7-minute speech by the South African Reserve Bank Governor. And Annabel, I'll get your take first.
Okay. For the MPC statement, I think, as we all know, the unchanged rate decision was as expected. But I do think that perhaps what is new is pushing out the timing of when the CPI inflation rate gets to 4.5%. Pertinent because, as the governor has said a number of times before, and also, of course, today as well, they're not looking to cut interest rates before they hit 4.5%. And of course, as well, also expecting it to remain sustainably around 4.5%. So not if it's just going to be a one-off and then potentially jump substantially higher. So that's one point. And possibly the other one is that he's making quite a note of the food price inflation. I think the previous meeting, there was some consideration that perhaps the El Nino effect might not have such a significant impact on South Africa's crop. And of course, now that has turned. Worse weather occurred over February and March. And of course, now that's likely to delay potentially the interest rate cut start, if obviously we do start to see that feed through into food prices. So yes, there's a lag between agriculture and what comes through at the retail level, but it's one of the risks.
Yeah, that also stood out for me as well, Annabel. The governor talking about the fact that the expectations for inflation to reach 4.5% have now been kicked out to the end of 2025, which is a lot later than the SARB had initially expected, the MPC had expected, and also it also lengthens or makes the path towards policy normalization something that is embarked on a lot later. Koketso, for you, your key takeaways?
Yeah, I think, unfortunately for me, not too much new or unexpected that came through in the statement. We did expect to hear the governor being a little bit hawkish, given the fact that we ourselves at FNB have been flagging upside risk to inflation, especially because we have the advantage of adjusting our forecasts a bit more frequently than the NPC does. So we do generally agree with the upside risk from food. We also think there's an upside risk to general core inflation besides just services, given that the first quarter the first quarter business confidence index that is published by the BUR did indicate that selling prices are rising. So we think that's also another indication that inflation risks are probably going to be tilted upwards. And furthermore, that maybe the disinflation that we expect in the second half of this year may be more shallow than what we previously anticipated. So yeah, I mean, for the higher starting point compared to what they had in January, plus these risks as well as unfolding core inflation normalization, especially on the services side, we think that it makes sense that they pushed out the stabilization or towards 4.5% to the latter part of 2025.
Okay, so Koketso, sticking with you, and Annabel, I'm also going to come to you again. In terms of any changes that you now have made to your projections for interest rate cuts, it's quite interesting because I feel like we are having a similar conversation to some of our colleagues over in the US, most notably, whereby you heard economists and investors there starting the year, or some starting the year with the prospects of around 5 to 6 interest rate cuts by the US Fed. That's tempered down to around 3. Some say 2, some say even 1. But the nutshell is that there are lower cuts that are now expected. And Koketso, I'd like to find out from you now whether you also have had to make some tweaks to your rate cut expectations, and if so, to what?
Yeah, so I think relative to the market, especially in the latter part of 2023, we were relatively negative, a bit hawkish in our expectations. We only expected the MPC to start cutting rates in July of this year. And generally, the cutting cycle will be very shallow. I mean, only cutting to 7% by 2026. So we generally expected, real interest rates in particular to remain higher than what they were relative to the pre-pandemic period. And I think more than anything, the MPC is emphasizing that, that will indeed be the likely outcome. So we're seeing high interest rates globally, especially in advanced economies. The Bank of Japan was also flagged today. So we're seeing that neutral interest rates, or the level of interest rates that is neither accommodative or restrictive on the economy, are rising relative to the pre-pandemic period. So the age of cheap money is behind us. And as a result of that, we will tend to see your riskier assets having to offer very competitive interest rate in order to attract that capital. So broadly in line, we have not changed our expectations as yet. We still expect about 3 cuts this year. We think that the market is also, relative to the market, we see that the market has moved their expectations to later in the year. So that's the risk, that interest rates could be more shallow and later.
Okay. So just briefly, Koketso, 3 cuts of what? Just in quantum for this year specifically?
Pardon me, yes, 75 basis points. So 3 cuts of 25 basis points each.
Okay. Annabel, as for you, it was interesting the question that the governor did get from one of my colleagues in the media, just highlighting the SARB's quarterly projection model, in which the model had a 50 basis points penciled in terms of cuts for this year. He didn't outright say that that's still the case, but nor did he deny that that also is subject to significant change. Have you made any changes to your rate cut expectations? And if so, how much do they differ from what FNB is saying as to 75 basis points still for 2024?
So going into the meeting, we already had September as our first month in which we get an interest rate cut. We expect it'll be a 25 basis point, and we also have November as well. So that looks like we're aligned with the QPM model potentially, but I don't think it means that much. It's very volatile. It can change so quickly. And of course, given what the governor said, combined with the model, would seem to imply their first cut, maybe a 50 basis point cut in November. But as I said, it's not certain yet. It's also a very long time away as well. We're only sitting in March. And many things can happen which could change the outlook before we get there. both as the United States is, South Africa also seems to become quite data dependent for its interest rate outlook, for its interest rate cut decisions. Previously, and I'm not saying that there's necessarily a big difference, but the Reserve Bank had looked at its trajectory, its forecast period. What the key consideration in terms of interest rate cuts, will inflation be at 4.5% over that period? And if not, to look for an adjustment. And of course, also it said as well, it cannot change interest rates in a 6 to 18-month period, really. So sorry, it cannot change inflation by changing interest rates in a 6 to 18-month period. So really, as a consequence of that, it's quite possible that we only get our 4.5% in September. That's what our model's showing us, giving the upward pressure that we get. But I do think that, the Reserve Bank's become more data dependent. In other words, looking at CPI inflation figures coming out each month, because it really wishes to return to target before it cuts. And of course, if we have an even worse drought than is currently being signaled, that may well prove to be the November month instead.
Yeah. Reza, I know that the markets also, the forward rate agreement specifically, also forecast their take on potential cuts for this year. Judging by what you are seeing on your screen right now, has there been any changes to the rate cut outlook?
No, there hasn't. So, right, if we take our cue from the FRA market or forward rate agreement market, then so then, as was said previously, there's one cut of 25 basis point that occurs around November, right? And there hasn't been really any major deltas to those figures as I'm seeing it now on screen, right? So that is essentially saying, sometime later this year there will be adjustment downwards. But basically, as Annabel mentions, I do agree that the SARB has in fact become a little bit more, let's call it granular in terms of the immediate data that it receives. And there's lots of water that needs to pass under the bridge, certainly in terms of the developed market central banks and the let's call it their policy evolution in this time, that could also affect the response function of the SARB, right? So it remains to be seen. I think the next 2-3 months become quite critical, in trying to get a handle on how monetary policy evolves, both globally and here in South Africa.
Okay, I mean, in terms of here in South Africa, of course, we know that the next 2 or 3 months or so is when we'll be hosting an election, and reference was made to the potential uncertainties that investors are seeing in light of that. But Reza, I want to come back to you again just to understand what we should be doing with the bond environment right now. The governor did make point of the fact that the rand is a lot weaker than it had expected as the SARB, and some of that weakness is being filtered by the fact that the Fed is also staying higher for longer in this environment, and that's giving quite a lot of support to the dollar, and also investing over in that market with less risks and all. Just given that backdrop and what you have heard right now, and as we, of course, step into election season, what are you telling clients about investing in South African bonds right now, and whether that's still a favorable opportunity?
Yes, so the way that we normally like to frame that exact question is by saying that there's in some sense a tug of war, with regards to the attractiveness of the South African bond. So on the one side, you have the fact that you've got very, very compelling yields on offer, whether you consider that in real or nominal space, but yields are high, i.e. bonds are quite cheap, right? And that itself is a very compelling case to be made. But on the other hand, you still have the harsh reality that financial conditions, factually speaking, are still very, very tight. I mean, you still have got an inverted US yield curve. You still got a very, very strong dollar. And if we try and express the global monetary policy stance in real terms, then you've actually still got monetary policy in significantly restrictive territory. So you try and now trade off this idea that you've got a very, very attractive and elevated front end of the US curve, i.e. the front end or money market proxies in places like the US is giving you 5% or 5% plus in USD terms. And that becomes quite a steep hurdle to clear for global capital to now want to say, I choose to now stick my neck out to plow money into a high carry emerging market destination when I can essentially get 5% in USD terms risk-free from the front end of the US yield curve. So that's why we say, even though you might have a situation where you do indeed have quite compelling real yields and compelling nominal bond yields here on offer, the global financial conditions landscape is not that conducive to sort of that classical carry trade taking place. So we would almost advocate an idea of being almost moderately overweight duration, having some duration, but being a little bit circumspect with regards to not going all in at this particular juncture.
Okay. Koketso, I want to come back to you again. So outside of some of the factors that cause wobbles in inflation, food and fuel and all of that, the government was talking about core inflation presently at 5% right now, but he made reference to services inflation and reference to the fact that South Africa is now joining the trend of services becoming a bigger contributor to our inflation than goods inflation. And I'd just like to understand if that statement is significant and whether there is any major concerns we need to deduce from it, in your view.
Yeah, I mean, it is quite significant. I think when we spoke about South Africa's position in terms of interest rates and inflation last year, we were still boasting the fact that, South Africa's core inflation has not reacted the way that we had anticipated. We had been cutting in forecasts for core inflation. It had surprises to the downside. So that was a positive story. Now that the core goods story is out of the picture, given the improvement in supply chain dynamics, that supply demand mismatch has now been, a little bit unwound. So there isn't that much pressure on core goods inflation per se, except for an undervalued rand. Now, when you match that with services that are now starting to pick up, which take up a bigger chunk, a slightly bigger chunk of your core inflation basket, it becomes a bit problematic to see services inflation almost more than normalizing to what we had seen pre-pandemic. And what I'm speaking to here is specifically medical insurance, which is, a big number that we got in February, where we did see a month-on-month 10.3% increase in that number. On a year-on-year basis, we're sitting above 12%, nearly 13%. So if you think about the pre-pandemic period, I mean, we would see medical inflation around 9%, for example. And then during the pandemic, we fortunately got that relief of, people not traveling as much, not using as much of their cover as they would pre-pandemic. So in 2021, 2022, we didn't get the increases that we would traditionally get before the pandemic. So that relief set in and allowed us to have lower services inflation. But now, sitting in 2024, we are back more than where we were pre-pandemic, speaking to the specific measure. So services inflation is definitely normalizing. I think for me, that is not necessarily the worry, given that we did anticipate that from the media publications that these schemes had put out already. The issue for me is if you have an undervalued rand that continues to be undervalued at least until the elections, if you have suppliers reporting that they're increasing their prices that they're passing on to the consumer, so you have a pass-through effect coming through, those two combined means that you could have higher core goods inflation than what we would hope for. And combining with higher services inflation as they normalize, that could result in stickier inflation than what we are anticipating for the remainder of the year. So that's where the risk comes in. That's where the importance of those trajectories come in.
Okay. Stickier inflation essentially means stickier interest rates then. And Annabel, I'd like to ask you what the risks of stickier interest rates or higher for longer interest rates could mean for the economy. This is a discussion that has been had worldwide, and the proponents of rate cuts are the ones that are saying that higher for longer could risk plunging economies into recession. I think that for most economists right now, particularly in the US, the R word is firmly off the cards. But when it comes to us, with the paltry growth that we're already experiencing and understanding the backdrop in which most households here in South Africa are finding it quite tough to survive, what are the risks for South Africa's economy as a result now of interest rates going to remain higher for longer because inflation is quite sticky?
So I think if it does, as we move through the year, if it does look like we're going to get stickier inflation, of course, the risks are very apparent. We probably would move to the November for our first interest rate cut, as I mentioned earlier. And what that really means, just moving by perhaps, 2 months, is not going to have a big impact necessarily on consumers. Also, it's a very small move as well, only a 25 basis point cut. It won't really move the dial on our economic growth forecast. It will, of course, obviously create some increase in confidence, consumer confidence, a bit of a fillip potentially to business confidence if we do see earlier interest rate cuts. That obviously is something that is always known. But of course, we do find ourselves in a situation where we are obviously struggling in South Africa because of the very severe structural constraints. I see the Reserve Bank says that 1.5% was taken off growth from electricity on its own. And of course, if we add the impact that Transnet's port and rail congestion had on the economy last year, you get substantially more than that. That is obviously suppressing economic growth in South Africa. In other words, instead of last year recording, 0.6%, we could have had 2.1% if we didn't have, such severe impact of load shedding. 2023 being the worst year of load shedding that has occurred in South Africa. And of course, potentially closer to 4 to 5% if not for the port and rail congestion. We also, of course, saw the very negative impact on government finances because of the loss of export revenue, but also, of course, as well, we did have the impact of weak commodity prices. So the global economy matters, and of course, what's happening in the US matters as well. If they did go into recession, it would be expected to have a negative impact on South Africa. Most commentators now believe that risk is off. But, for South Africa, I think we're potentially a bit less sensitive to interest rates than in the US, and our structural issues really come to the fore for us. But of course, going back to our modeling, we really do see also as well that when you get an interest rate cut, it has an impact out to about 3 to 4 quarters as well. So, that is also important. But such a small cut, only 25 basis points, and shifting it in our model from September to November, as now, the governor's hinting at, would have a limited effect on growth for us. But obviously for consumers, a quicker and bigger interest rate cut is always welcome.
Of course. Reza, just to give a last word to you, just focusing, of course, on the currency right now, which by the governor's own admission is undervalued. Just your take on this rand and where you see it going and what gets it there?
Yeah, so just to echo some of the previous comments, the idea is that both the bond and currency markets are, in our view, massively indexed to what happens globally, and that this idea of this very, very attractive front end and almost risk-free rates that are on offer in places like the US, it really scuppers that kind of risk-seeking capital flows that normally are so supportive for the currency. And we've effectively seen this kind of phenomenon. We've seen this empirically by, if we just examine the stats, with regards to foreign ownership of our South African bond market, that number has now dwindled from around 42% all the way down to 25%, and which really means that foreigners are not really coming to our weekly bond auctions, in the kind of numbers that, were perhaps akin or representative of the post-financial crisis period. So foreigners have been absent. And the reason that they have been absent is simply because there's such a high hurdle rate for that capital moving here. So I think that, like so many other things, the evolution of inflation in the United States, the disinflationary process there, the kind of traction it gets for, when shelter inflation will start almost catching up with the kind of disinflation we've seen in the goods sector. When that does happen, you have more pronounced disinflation there, and that really provides a little bit more of a supportive backdrop to perhaps see those interest rates cuts happening in the United States. When that in turn happens, that will change the entire complexion of global capital flows, and the rand and other high carry emerging market destination, as I said before, is usually a beneficiary for that. So once the party starts happening in the US, I'm sure the ripples will be felt, all across the emerging market complex, South Africa being no different.
Well, I think someone needs to call the DJ real soon, because I think a lot of South Africans are ready to dance to a more favorable rand at this present moment in time. But to all of you, thanks so much for your time, just giving us those insights and the color on the latest path for monetary policy here in South Africa, ultimately what it means for the economy and what it means for money. I was in conversation with Annabel Bishop, the chief economist at Investec, Koketso, Mano, senior economist for FNB, as well as Reza, Ismail, the head of bonds at Prescient Investments. The SARB governor also, of course, making a reference to that Jafeka account, that's the Golden Foreign Exchange Contingency Reserves account that we first learnt about earlier on in February from the finance minister, the account in which government aimed to tap to help it reduce some of its fiscal risks and borrowing costs. It seems like that monies that was expected to filter through, be passed on to Treasury, has not yet been released. There's a few T's and C's that still need to be passed regarding policy and legislation. I think we're actually going to hear a lot more on this development in the days to come. But as for the MPC, we leave it there, 8.25%. If you are a saver, good for you. If you've got a lot of debt, perhaps look to try and clear it up as soon as possible, because borrowing costs are still high. I'm going to wrap it up now. My colleagues in East Africa, of course, waiting to give you the latest developments on market movements there. I'll see you in an hour or so as we wrap up the South African trading day. Goodbye.